Hi class, welcome to lesson number 21 in our continuing microeconomics class. Last class we went over perfect competition, and we're going to continue about perfect competition because there's a lot of details when it comes to perfect competition about, how do you graph perfect competition in terms of their costs, or how do you see if you can have a profit? Where do you decide to have profit? So all these questions we're trying to answer in this particular lesson. Before I do, you guys see some writing in the back. This is from the last class, and basically the homework question was, tell me the 4 main characteristics of perfect competition. One is to my left. It says that in a perfect competition, producers and consumers are independent, and there are many of them, and they're also small. So they don't make a big impact, because if they're large, that'd be a monopoly. So in perfect competition, we have small, independent, numerous producers and consumers that cannot impact the market price by themselves. Second is to my right. It says that firms produce a standardized product, which means that it's homogeneous. No firm can differentiate, with the other, because they all produce the same product. Okay. Third is that there's no barriers to entry or exit. Profitability is what dictates entry or exit. But typically speaking, for a new entry to enter or for an old firm to leave, there should be no big obstacles in perfect competition. And lastly, fourth is that all firms are price takers in perfect competition, because the market is what dictates their price. It's not individual firm, it's the market that dictates the price. Okay? So these are the 4 main principles in imperfect competition. We're going to continue this perfect competition with, talking about, I think, graphs is what we're going to start off with in terms of demand. Okay, so we're going to start off with demand. I'm going to show you how that works. We talked about elasticity before. We said that, in a perfect competition, a particular firm is going to have a perfectly elastic demand. So we're going to write that down. We're going to graph it. So let's start off with that. Okay, so let me go ahead and erase this. But one important thing when I'm erasing I want to talk about is that, when I graph these, I'm going to have 2 different graphs, and one for the perfect competition, the entire market, okay, that we're in. So it'd be like the example that I have is the U.S. wheat market, and the other graph I'm going to have is the one single wheat producer. And you have to notice the demands are different, and I think students make a lot of mistakes there. So watch carefully the differentiation between these 2 graphs while I erase these. Okay. That's good enough for now. All right, so we'll start off from the side over there. And first graph we'll have is we'll draw the U.S. wheat market, okay? And for the purposes, this is a perfectly competitive market, okay? So we're still in perfect competition. I can go ahead and write that down. I'll use another marker here, but basically it's going to be perfect competition. Okay, so we're still in perfect competition. I'm still writing this down just because everyone should be on the same page. Okay, so anyways, the first graph we're going to draw is, I said, the U.S. wheat market, right? So how does the U.S. wheat market, which for our example is perfectly competitive, how's it going to look like? Well, title's always important, right? You guys have seen this before, right? Quantity or output, right? And your price over here, okay? Now, typically speaking, we've drawn these demand supply graphs before. We typically have a downward sloping demand graph, and there's no exception here, right? An upward sloping graph, right? No exception here. The only difference that we have here is that we said that in a perfectly competitive market, they're price takers. So the price is actually set by the market at a certain level, right? So at this equilibrium where demand meets supply, right, price is going to be set, okay? And we'll call this price at equilibrium, PE, and we'll call this quantity where demand meets supply, right, quantity equilibrium, okay? So notice that in the market, in the U.S. wheat market, right, the demand is not actually perfectly elastic, okay? You see that the price line is flat, okay? But the demand is not perfectly elastic. So make sure you don't make that mistake. Now, the second graph we're going to draw over here, okay, that's going to have the individual wheat producer. So we're going to choose a single wheat producer, right? And one of the reasons we draw this graph next to each other is we're going to actually carry over this price, okay? Because remember what I talked about before. I said that in a perfectly competitive market, we said that the market is going to dictate the price, okay? The equilibrium between this demand and supply is going to dictate the price, and it's going to dictate the price that this guy, this individual single wheat producer is going to have, right? So I'm going to carry this over. Now I'm going to have a flat line. And notice the most important thing here is that in this case, in the case of a single wheat producer, right? So this is a single firm, okay? He's actually going to have a perfectly elastic demand line, okay? So this is the most important differentiation, okay? So we don't have a perfectly elastic demand in the market, okay? But when it comes to the firm, we have a perfectly elastic demand when it comes to perfect competition, okay? So demand here is equal to the price equilibrium. This obviously is the same thing we carried over from there, price equilibrium. So this is the way we're going to start off this particular lesson, kind of showing, differentiating the market, right, versus a single firm, okay? So understand where it's perfectly elastic for demand for the firm, but the wheat market is not perfectly elastic, but the price is flat because remember they're price takers. So understand this because they're both important things to know. All right, that being said, this is quantity, that's price. So I'd like to move on from this from these graphs because we're gonna come back to these graphs later on. But for now, I'm gonna go ahead and erase this and talk about profit maximization. Okay. So I told you before that the firm's goal is to maximize its profits. Perfect competition is no exception. All firms in perfect competition also like to maximize their profits. And we'll talk about how they do that, right? So still in perfect competition. And our topic now, subtopic, is going to be profit maximization. Profit maximization. All right, profit maximization. Okay, so remember our profit equation, right? We talked about accounting profit, economic profit. Obviously, this is an economic class. We're going to talk about economic profit in this class, right? So economic profit or econ profit. Econ profit is pi, right? This is econ. I'm just going to put it in parentheses, okay? So profit is equal to your total revenue, right? TR stands for total revenue, right? Minus your economic cost, okay? Economic cost. Okay? Total revenue minus total cost. That's what this is, okay? Economic cost basically says that in economics, we also put an implicit cost. We talked about opportunity cost before. Those are the things that kind of go into economic cost, okay? Typically speaking, you don't have to worry about that as such because they're going to, in the example they're going to give you, chances are they'll just give you the total cost and you have to just have total revenue minus total cost equal to your profit. But know that in economics, we actually factor in implicit and explicit costs, okay? Not just explicit, we also factor in implicit costs. Okay, so, we're talking about economic profit. Let's give you like a simple problem. So we talk about the U.S. wheat market, right? So I have 3 columns, okay? So for this example, right, I have bushels of wheat, I believe. Wheat, which is just a unit of wheat, okay? Doesn't matter if you know the word or not. This is going to be the price, okay? I'm going to have the total revenue, total cost, TC, and finally the profit. Know that total revenue minus total cost gives me the profit, okay? So my bushels of wheat, I have, for the example, I have 0 and 1, okay? For 0, my price is going to be $11 constant. That's what my market dictates. Remember, we're not going to change it unless the market changes it. So for this example, the market has not changed. Demand and supply have stayed intact for both 0 and 1 units of wheat. So the price of wheat has stayed constant, $11. Revenue, obviously, if you sell 0, is going to be 0. Total cost is going to be something. Why? Because remember, fixed costs, you still have fixed costs when you produce 0, okay? You still have to pay rent, you still have to pay electricity. Even if you produce nothing, you still are going to have some fixed costs. For this example, we can make up the number as such, but it could be anything, right? It could be 6, and your profit is going to be a -6 because you've made nothing, you spent $6, and your profit is -6. Now, this one, we've sold 1, right? So your total revenue, if you've sold 1 of unit of wheat and you sold it for $11, your revenue is going to be $11, okay? Now your total cost is going to be your fixed cost, which was $6 before, and I'm just going to make this up. We're at $4 of variable cost, so I'm just going to say $10, and your profit is going to be 11 minus 10, your revenue minus your cost, and that's $1, okay? So that's your profit. So, I've kind of got this pretty simple stuff, right? Mathematically, revenue minus cost, total revenue minus total cost giving you profit. We've calculated this. But the point is that how do you decide if you're in a perfectly competitive market, right? How do you decide how many units that you produce? 1? Do you produce 2? Do you produce 50? Like, what is the number, right? So as a producer, you're always thinking, well, what's the exact amount, right? And yeah, you can always look at your profit. You can, have like data, and you can see, okay, well, this is the max amount of profit I make. You know what? The answer is going to be 49 units because 49 units out of 50 units makes the most amount, whatever it is. But that's kind of cumbersome. Plus, it doesn't exactly make sense, right? I mean, you need a lot of data, you need to plot it out, whatnot. The neater way to do profit maximization, right, is using a golden rule in microeconomics. And this golden rule, right, I hope everyone understands it because it's really, really important. I'm going to go over here, okay, erase that graph, and tell you guys about this rule that makes profit maximization problems in perfect competition really easy, okay? So what is this golden rule we're all talking about? If anything you need to know, just know this. It's really important for perfect competition. The golden rule is the following. You make the most amount of profit, so profit maximization whatever, I'm trying to fit the whole word here, but you get it, profit maximization, okay, occurs when your marginal revenue, okay, MR, is equivalent to the marginal cost. This is the most important rule when it comes to perfect competition. Know this, memorize it, sleep with. If I wake you up and sleep, you better know MR equals MC, okay? Because this is the most important reason, okay? The reason being is you've heard of marginal benefit before. So marginal benefit, we talked about marginal analysis. We said, okay, well, what is marginal benefit, right? We said that marginal, we said that it's one more. What happens when one more? We said benefit is like how much benefit am I getting? Pretty straightforward. So marginal benefit is how much do I get if I add 1 unit of output? Marginal cost is if I add 1 more unit, how much does it cost to me extra, right? So typically speaking, I think we've talked about this before, but I'll state it again, okay? If your marginal benefit as a producer, okay, MB is marginal benefit, is greater than marginal cost, right? Is greater than marginal because you're getting more benefit than cost. The rule is you always produce more, okay? You produce more. Now, why is that? Because you see, when the benefit is greater than your cost, you're making a profit, okay? So the rule is, if this is always greater than the cost, keep on doing it and keep on doing more till you kind of run out of it because you want to make the max amount of profit. Remember, every time you're a firm, you're trying to maximize your profit, right? No one ever owns a company and says, you know what, I'm not going to make more profit. I don't want to. I don't feel like it. No, the point is to make the max amount of profit that there is, okay? Economically, that's what makes sense. And even intuitively, that's what makes sense, right? As a person, even if you're selling lemonade, you want to make the most amount of money, right? You're in business because you want to make some sort of money. And if you give that to charity or whatever it is, that's up to you. But the point is, you want to get the max amount of benefit out of it, okay? And that could be financial or whatever it is. But the point is, you want to get the max amount of benefit. So generally speaking, if you're a firm and your marginal benefit is greater than your marginal cost, you say you produce more. All right, so what happens when marginal benefit is less than marginal cost? So you're not getting as much benefit, but your costs are high. Well, don't produce, just produce less, okay? Produce less. Why? Because your costs are higher than your benefit. Why are you producing as much? Cut down so you don't have as much your costs are not greater than benefit. So if your marginal benefit is less than marginal cost, you produce less. Okay, so where do I stop? You're telling me produce more, produce less? Well, you probably can guess it, right? When marginal benefit equals marginal cost, you produce at that point, right? Or rather, you stop at this point. Okay? You stop at this point because your benefit is equal to your cost, and this is the point. Beyond this, you're going to make losses. Less than that, you're not going to be as efficient. So marginal benefit is equal to marginal cost. You stop, okay? And this is the principle, right? Your marginal benefit is your marginal revenue, right? As a firm, you sell something, you make money. That's your revenue, right? Your marginal revenue is kind of like your marginal benefit because your benefit is your revenue, the amount of money you're making, okay? So when marginal revenue equals marginal cost, it's kind of the same thing as saying MB equals MC. You stop here. So when you want to maximize your profit, MR should equal MC, okay? So this is the fastest way, right? So to my left, when I wrote that chart, right, when I just had the simple example of saying, okay, well, I had 0 bushels of wheat, I have 1 bushel of wheat. What do I do? Well, where do I stop? Is it 50? Is it 49? Well, the thing is, you have to figure out where your marginal revenue equals your marginal cost, okay? And where that is, at that quantity, that's where you stop, and that's where you produce as a firm, okay? So MR equals MC is this golden rule that you have to use for profit maximization, okay? Because that's where you maximize the profit, all right? So with that being said, let me give you an example, okay? So imagine, same concept here, Let me walk over here so it's a little easier for you guys to see, right? So we said MR equals MC, we stop here. So let's say instead of 0, 1, and whatever number, and then let me erase these, okay? I have 3 units, 4 units, and 5 units in this example, okay? So how many bushels of wheat? I have 3 units. We can stick to the same price, $11, 4 units, and 5 units, okay? And how much do I make revenue? Well, you take 11 times 3. If I'm selling 3 at $11, it's $33, right? Your revenue. 44, okay, and 55. Pretty straightforward because you take your price times your amount of quantity, your price times the quantity you're selling, you get your total revenue. Pretty straightforward. Total costs are given in this example, okay? We have 34, 42, and 53. 34, 42, and 53. Okay, well, your profit, right, here is total revenue minus total cost. 33 minus 34 is -1. 44 minus 42 is 2. 55 minus 53 is 2. So your profit here is negative. Okay, so obviously you don't want that, right? Unless that's the best you can do. And these two seem to match. Okay, well, how do I decide whether to produce 4 or 5? Remember the golden rule I said, where marginal revenue equals marginal cost, okay? So let's figure out the marginal revenue and marginal cost. Marginal revenue is the change in total revenue, right? Per the change in quantity. Well, the quantity change is just 1. So you don't have to worry about the denominator, you have to worry about the numerator, so which is a change in total revenue. So here I've changed 11, right? Here again I've changed 11, right? 33 plus 11 is 44. 44 plus 11 is 55. So my total revenue has been changing in the units of 11. Why is that? Well, think about it. We've changed only 1 unit of wheat. My price hasn't changed. So here's the following lesson you've already learned, right? It says that in a perfectly competitive market, right, your price, P, is equivalent to MR, your marginal revenue, okay? In perfect competition, your price always is equivalent to the marginal revenue. All right, so we figured that out. Okay, what's the marginal cost? Well, the marginal cost, again, if you're changing only one quantity at a time, right, is just the change in total cost. Well, total cost from here to here, 34 to 42. 42 minus 34, well, that's about 8, right? That's 8, right? So plus 8. 42 to 53, that's 11, right? So my MC from here to here, from 3 units to 4 units, marginal cost was 8, okay? 42 to 53, marginal cost was 11. I said stop when marginal revenue equals marginal cost. Marginal cost here is 11, right? Marginal revenue is 11, marginal cost is 11. So at 5 units, right, of 5 bushels of wheat, my MR is equal to my MC, which is equal to 11, right? So I stop as a firm here and I produce at 5 units, okay? That's how you maximize profit. So if someone asks you, say, in this example, how many bushels of wheat should I produce as a firm in a perfectly competitive market? I produce at 5, okay? MR equals MC at 5 units. I produce at 5 bushels of wheat. Why? Because that's the most amount of profit I can make. Again, I'm going to say that one more time. Marginal revenue equals marginal cost at 5 units. That's why we produce at 5 units, okay? Figure out the marginal cost, figure out the marginal revenue, make sure they're equivalent to each other, and at that quantity, that's where you maximize profit. Through the process, we've also learned that price equals marginal revenue in a perfectly competitive market. All right, cool. So, understand that. That being said, let's figure out some more stuff, okay? Let's figure out more properties when it comes to perfectly competitive market. So one thing we already talked about is we maximize profit at MR equals MC. We said that price equals MR in a perfectly competitive market. What else can we figure out? Well, let's see. Let's try to erase this part. And let me go over a couple more principles using algebra, right? And to a certain degree intuition to kind of explain to you guys how things work. Let's go over your formula for marginal revenue. Hopefully people remember that, right? So your marginal revenue, right, MR, is equivalent to your change in total revenue over the change in quantity, right? So change in total revenue, what is delta TR? Well, delta TR is just the change in quantity times price over the change in quantity. Well, if these two are the same, right, MR is equal to P. That's why we have this property in perfectly competitive. That's why P equals MR. All right, so we get that. We get that price equals MR in a perfectly competitive market. But there's also another property. AR, which is average revenue, is equal to TR, total revenue, or quantity. Now, if the quantity, TR is equal to P times Q, and that's divided by quantity, guess what? In a perfectly competitive market, average revenue is also equal to P. Okay, so we know another thing now. So using algebra, we've kind of figured out that average revenue is equal to price. So we can say in a perfectly competitive market, price is equal to marginal revenue, but it's also equivalent to average revenue, right? So now we have two rules. We had MR equals MC at profit maximization. We said in a really perfectly competitive market, price equals marginal revenue, which equals average revenue, right? Pretty cool. Okay. So that being said, let's try to understand how, let's try to graph it. Okay, so let's try to graph a perfectly competitive market. Okay. We've kind of gone through the algebra. Now is the graph part to understand how a perfectly competitive market works. Let me get the X and the Y axis going. Okay. I have quantity over here, price over here. Let me make sure I get the right model down. We're actually going to talk about a single producer. Okay, so we talked about wheat. Let's stick to that. We'll say one wheat farmer. Okay, farmer in this case is the firm. Okay, remember if you're talking about one single firm in a perfectly competitive market, what is it? Is the elasticity of demand perfectly elastic or is it not? The answer is it's perfectly elastic. Okay, so your demand kind of looks like that. And I'm going to note that it's perfectly elastic because it's one single firm. I'm going to use a small d because the reason is, remember when I drew the original market, the entire market of wheat, D is capital and it's not elastic. It's not perfectly elastic, right? So this one is just talking about one wheat farmer, so I'll use a little d. And this is the price equilibrium, right? This is where he's forced to sell his wheat at because in a perfectly competitive market, he's a price taker, so he's forced to take the market price, right? Whatever the market dictates. So right now it's at price equilibrium, right? Whatever that is, it could be whatever the market says it is. So this is the demand. Also, this is the demand line. Now remember one thing. So we said this is the price, right? Using this box over here, we established that price is equal to marginal revenue, which is equal to AR. So I'm going to do that. Price is equal to MR, which is also equal to AR. So when you draw in a perfectly competitive market, when you draw a single firm, right? You have to draw a perfectly elastic demand, right? Perfectly elastic demand. But also remember, you have to set it equal to the price, right? Obviously the price is the market, they're a price taker. This is the demand, but it's also equal to AR and MR. It's also equal to average revenue and marginal revenue. And we've derived that a couple of minutes ago. Okay, so what's the other piece that I'm missing? I have the revenue part. What's the other part? It's cost, right? So remember, I'm going to bring in my marginal cost now because remember, what did I say? The golden rule, right? This big box over here, right, says marginal revenue equals marginal cost. That's where profit maximization occurs. So I have marginal revenue here, right? This is marginal revenue is equal to AR, which is equal to price, which is equal to demand, right? A lot of things going on here. But the one thing I'm missing is marginal cost. Remember that Nike swoosh I was talking about, right? This MC is kind of that check mark, and it's exactly how it looks. Kind of looks like this, right? And this is my marginal cost. Where do I produce as a firm? Well, marginal cost equals MR. Where does it equal? This is my MC line. This is my MR line. My MC equals MR right over here. So I go down where that happens, and that is where I produce. That's quantity equilibrium. QE stands for quantity equilibrium. I sell those many quantity of wheat as a single producer. I sell it at this price because this is what the market tells me to sell at. And I do that, and I found that out because I saw where MR is equivalent to MC. I hope everyone understands that because it's really important, okay? The way you derive the equilibrium quantity is using the fact that MR equals MC. Your MC is this check line kind of thing, right? Your check. Your MR is this flat line because it's perfectly elastic demand graph, which is also the price, and we said price is equal to MR and AR. That's how we derive that. Every time you draw a firm in a perfectly competitive market, should have a perfectly elastic line, and you should always say little d, demand, is equal to price, is equal to marginal revenue, equals to AR. If you don't have this on a test, they'll deduct it, okay? It's something that's kind of given, okay? So you memorize that again, okay? And if you don't understand the logic behind it, go ahead and draw that, that algebraic conclusion that I gave you, that algebraic logic, or the graph or whatever works for you, or the charts to understand that price equals marginal revenue equals average revenue in a perfectly competitive market. Either way, you have to know that. Okay? All right, so we went over a couple pieces here. We know where they produce it. We know that they produce it in marginal equal revenue equals marginal cost. And this is a perfectly competitive market. Good news is that you guys know the golden rule to my right, marginal revenue equals marginal cost. And hopefully this is going to be your ticket to a 5 in microeconomics. I'm partially kidding, okay? But obviously you have to know this, okay? Obviously there's a lot more to know, but you have to know this, guys, okay? The bad news is you still have a little more about perfectly competitive market to go. The good news is you know that much, and you will knock out perfect competition even in your sleep if I wake you up, right? So that being said, we have a little more to cover. We're going to figure out the good stuff where it's like, how do you figure out a profit in a perfectly competitive market? Using graphs and simple tricks that I'll try to teach you guys in the next class. So we'll wrap up perfect competition in the next class. And just to summarize it, we've gone over perfect competition. We've talked about MR equals MC. We've talked about price equals MR equals AR, right? And every time I'm saying a word, AR or MR, I mean average revenue or marginal revenue, okay? MR equals MC, marginal revenue equals marginal cost. That's where profit maximization occurs. So the big summary for this lesson is marginal revenue equals marginal cost. That's where I maximize my profit in a perfectly competitive market, okay? So with that being said, here's your homework question. Your homework question is, draw me a perfectly competitive firm, okay, not the market. Actually, you know what? I'll do both. Draw me both a perfectly competitive market and a firm with their demand and supply. And in the firm, you can draw me just the demand line. Okay? So with that, I'll see you guys in the next class. Hopefully, I'll join you guys in the next one and talk about perfect competition. We'll wrap that up and move on to oligopoly, monopoly, monopolistic competition. Okay? And at the end of it, we'll make you guys microeconomic experts.